Hey, good morning, Chris. How you doing, man?
What's up, man? I'm great. How are you? I feel better. My voice is no longer that whiny, nasally COVID experience, so I feel better.
Yeah, you
Yes.
sound good. Sound good. This is Brian Jones. I'm here with Chris Hood, professional options trader. Interesting man. Survived COVID, bounced back, no problem. Armbar.
COVID took one look at my beard and decided that was it, man. Can't stay with that guy. Got to move on. And it's literally going through the community, man.
Is it,
It's
no, is the case rate high up there?
yeah, there've been a lot, and a lot of my training buddies have got it as well. So it's been tough. I mean, the thing is, it affects people in different ways, right? At my age, when you're geriatric, you know, it's not that cool. It wasn't cool.
No,
Don't really want it again.
I got it and it was not pleasant. It was terrible. So what are we looking at in the market today?
Oh man, it's been really tough. I have to say the last 2 weeks have been very, very difficult, no matter what strategy you've been doing. I mean, it hasn't been easy. There's so much external volatility coming in from things we can't control, Russia, all of that stuff, and the geopolitical issues of the day. It makes it even more important to rely on systems that don't have a bias, number one, and also take your emotional side out of things. It's been tough. It's not easy, but there's some bright lights on the horizon, right? So this is not going to last forever. This kind of volatility, it does have to calm down. There's some good opportunities in the market at the moment. I mean, you've seen we've nailed out a couple of doubles and a couple of triples, but for traders that are trading without systems and tools, it's a lot harder to read, and just trade carefully. But yeah, it's going to be interesting. We got CPI numbers coming out. What that's going to do to the markets, anyone's guess. I love watching these social media groups where everyone's a guru and everyone's like, this is what it's going to do and this is what it's going to do, and everyone's comments tend to age horribly. And I'm just like, don't try and get into a guessing game as to what's going to happen. Rather just react to what is happening instead of trying to predict things. If you predict things, it's a 50-50 gamble. It's like, don't put all your money on red when you go onto a table, right? So got to trade it a little carefully. XLP is moving. The consumer staple sector is moving. Let me pull up the
We set this.
rotation.
One second. I didn't set this so you could share. All right, you should be good to go now.
Okay, yeah. So let's have a look at rotation. Always a good place to start when looking at the market is where's money flowing, where's money flowing from. So let me make this bigger. All right, so when we look here, you can see over the last 5 trading days, let's make it 7. And some people say to me, why 7? Because it's greater than 6 and less than 8.
Beautiful.
There's no real science to what time frame you use, but you can see XLP. Is it sharing?
Yeah.
Okay. You can see XLP moving strongly straight from this lagging sector right through into the leading. Real estate, utilities, biotech also moving strongly there. Materials, doesn't really know where it's going. Technology pulling back. Energy, energy is coming in from this weakening sector. It's coming back into the red. And remember the rotational rule, right? We sort of go from green down into yellow, into the red, up to blue, and so on, right? So over the last couple of days, we are seeing some sectors getting a bit more money than others. So staples is getting a bit more at the expense of semis, at the expense of technology, at the expense of discretionary, right? So that's Tesla and Amazon, that's Apple and Microsoft, this is Nvidia and AMD and the like. So yeah, it's not an easy market to trade, because if you start taking the green and saying, well, I'm only going to go and trade in the green, well, these are the sectors that are going to find money coming out of them, moving into the sectors that are red, right? But we don't know the timing at which that will happen. So you've got to watch this pretty carefully. So, people are going to be taking profits here over the next couple of days. We should see these coming back. We should see the money rotating into industrials, finance, and energy. Technology may be a beneficiary of that rotation once it starts to happen, but you've got to keep your eye on it, right? You can't just assume that things are going to be the way that you think they are. Be very careful about applying your opinion and forcing your opinion into your trades. Rather look at what's happening and move there. XLC is interesting, moving here from the blue into the sort of midpoint here. It could either come down this way or it could go that way. So watch Google and Twitter and Disney and Facebook for that one. Semiconductors just looks like they've been smashed. I mean, this is definitely the most unloved sector of all.
So is it a good time to pick up shares of SOXL then?
Yeah, well, that's my long-term approach, because once these sectors start to regain, favor, they move very, very fast. So it's not a sector that you can time easily. All right. So if you're trading this one, I've got some short calls on here just to reduce my break even of my trades. But you can see this has been really sold off, right? Volatility band shifted color, breakdown below the 21, drops down towards the zone of resistance here. It needs to get through this. It needs to get back above this red zone and then come back up here. Now, whether this will actually come down, come back up to the 21 and fail again will be a function of these oscillators here at the bottom, right? So we've got the squeeze that fired short. We've got our stochastic that's coming into oversold. This could easily start to hockey stick and turn back the other way. Once this goes to yellow and this starts to go dark red, we may have signs of a reversal with this coming back up. So I tend to buy more stock whenever this comes down into these sort of lower price levels, which was down here back in the early March. So I do that because I think in the long run, semis are going to be the, sorry, you guys have been watching my side of my head, which is not very attractive. What you should be looking for is what's going to be your long-term view, right? The long-term view is semis are going to come back and rebound. And what I want to be doing is buying it down here in the 20s for it to get back up here to the 70s. That to me makes the most logical sense, right? So if you've got a long position and you've been accumulating, these are good opportunities to average down. You can sell some call options against it at these levels to bring in some income to further reduce your break even, because the long-term view is, look, at some point it's going to be back up here. When it's back up here and I've been averaging down here, I'm going to gain. If I haven't and I bought up here and I'm just like, oh my God, this is terrible. What that does is it creates this sort of psychological overhang, right? So there are a lot of people who bought up here on that break, on that divergent low, and they didn't get out. And what they did was they sort of held on. They didn't average down. They didn't sell calls. They didn't do anything to minimize their break even. And what they're doing is they're sitting here and they're going, okay, if this just gets back up here, I'm going to sell all of them, right? That's the sort of liquidity overhang perspective, right? So be careful of that. There are a lot of people that buy, on false breakouts, and what happens then is they're just waiting for it to get back up there, and that could create more liquidity on the sell side. So, it's just about being careful. So I like the look of SOXL in the long run. Obviously not now. I mean, this is not a particularly attractive chart. What I'm looking for is a green volatility band. However, if this price can just get above, 34, somewhere around here, break above the 21 and get back into this zone here, there could be something. So it's not something that I would say to people who've got no position, start buying. There's definitely not something there. But for my long-term trades, this is what I like to do. So I'm a big fan of the sector. So yeah, interesting play. But let's look at a couple more. So XBI is one that's pretty interesting, is the biotech. I mean, you can't get more beaten up and unloved than this one. This stock trades a lot like my jiu-jitsu, inconsistent and erratic, and not very good for the long term. Do
you like this or IBB better?
It depends, right? The difference is the weighting of the individual components. So when you have an equal weighted index, you tend to get a more muted response to big moves. If you've got a higher concentration on certain stocks, obviously that stock will have a greater impact and influence on the movement of the index. So it depends on what you're trying to do. For me, I still like LABU, right? So I'll rather take the triple leverage version of XBI and trade this one. Now, LABU.
Do you accumulate shares of this as well?
Yes, when you trade a triple leverage stock, be very, very careful of accumulating options in it, because the theta erosion that happens when you've got these big movements, or the sort of delta degradation that you get on these declines, is not very good. You know, it's very bad for someone holding out of the money options. So what you would do is you'd accumulate stock. Okay, obviously here we don't have an entry. We don't have a valid entry here at all. Volatility band has shifted color. So I'm looking for a green vol band. I'm looking for the squeeze to fire long. I'm looking for the stochastic to turn green. And then perhaps there's a trade. So where would the trade entry be? Well, an aggressive entry would be somewhere around 19. You can see I've got these two levels here. Once it breaks through those levels, if this is bullish at the bottom, then we're more than likely going to be moving up to 38, 39. You know, if I can get in at 20 when this has started to shift color, I'm okay with that. I don't need to get the whole move. And I think this is a really important concept for a lot of traders. Try not to get, you know, you don't need the whole move. You could still be really successful getting 80% of the move, you know, 70% of the move. Always look for your confirmation to trade. Don't just run off and say, oh, well, the 9's crossed the 20, let's go and trade. Really keep it in mind that you need confirmations. And one of the things I try and teach, certainly to my clients and to guys that I teach, is look for multiple entry signals in clusters that come from different sources. So if you're using an MA cross, remember an MA cross is a lagging indicator. It doesn't give you indication of where price is going. Price is already moved, and now you're getting that average, right? So remember that. It's a really important thing. A moving average is not a leading indicator. It's a trend indicator. And when you've got stocks that are trending, your moving average crosses tend to work really, really well. When you've got leading indicators here, like your oscillators, these tend to work well in ranging markets, things that tend to go sideways, where things have already started to bottom out. These are going to give you a far greater accuracy around triggers for reversals than a moving average. So, you know, always understand that. It doesn't mean one is better than the other. You know, that's often a debate that you see in social media, where people will go, well, my technique is better than yours. You know, at the end of the day, there's no such thing as the best technique. The only technique that works is the one that makes you money. You know, it doesn't matter what it is. And you can often find, you know, traders being so opinionated and, you know, willing to die on a hill for a particular indicator. No, you know, it doesn't make sense to me, right? Just be profitable, be consistent, and trade whatever makes you money, right? And at the end of the day, if you make money using strategy A and I make money using strategy B, we both made money, right? Does that mean one's wrong and one's right? Doesn't matter. You've just got to be consistent. So the way that I like to trade is, if I've got a lagging indicator and a leading indicator, all telling me the same things at the same time. So, you know, when there's that overlap, you tend to have a higher probability of a winning trade. So I look for a 1321 cross on the daily. I try not to trade, sorry, COVID still has some squatters. You know, what I try and do is trade a 1321 on the daily and avoid the 813. The 813 is a little bit too quick on the daily, and it's a little bit, it can be disingenuous to someone who doesn't plan a trade properly, because you can get in and out pretty quickly on an 813. All right, a one-day move can reverse an 813, and then you got in yesterday, you're out today, you missed the exit, you're now down. So what I'll try and do is a 1321, and then I'll make adjustments within my squeeze tools. So I don't always trade a squeeze histogram or a squeeze cross as my entry trigger. What I might do is trade the squeeze histogram cross of 0 together with a stochastic. So I can take, in my tools, I can take what works for each of the components of the tool, right? So in the squeeze tool, for example, we have 7 indicators. There are components of each of those 7 indicators that, when combined, can actually make an optimum entry, rather than just assuming that this entry is working and that exit works. So I could take an entry from the histogram, I could take the exit from the stochastic, I could take an entry with the histogram plus the vol and the exit from the stochastic, or any one of 7 indicators. So the entry from one, the exit from another, or entries from 3 and an exit from 1, all of those will adjust your numbers to give you an expectation of movement. And then that will determine the strategy that you'll use, right? You don't sometimes with a lot of people, they'll go, I trade long calls. And they will do long calls on every single setup that they've got. And that doesn't make sense, because there's certain setups where you've got low amplitude expected moves, or you've got low probabilities. Don't do trades that are going to give you a higher probability of losing, or strategies that are going to lose in those types of environments. So understanding how those all connect is really important, particularly in markets like we have now, because one day we're up, the next day we're down, the next day a Fed guy says something.
You were saying like things. I think you said something about this in an email about with the low probability setup. Sometimes that bull put spreads, or selling credit spreads, especially durational type things, might be a good plan, because it doesn't have to move up as really quickly for it to close.
Yeah. So when you've got high probability, let's look at it this way. When you're going to plan to hold a trade, let's build something. Let's use SPY just for argument's sake, and we're going to build something here. So you can see SPY trading underneath the 21. It's going to gap up today. Did we know it was going to gap up today? Yeah, pretty much, because the movement that we had from here to here is pretty severe. This is +3 ATR. We're down by -2. Things have to revert back to the mean. This might just be a reversal back to the 21. So let's work this out. So when we open up our tool, we go over here. We want to use, let's say we're going to use the squeeze histogram. I'm going to use my volatility levels. I'm going to use 1.8. So I'm just going to change that to 1.8. So that will narrow down these bands. Once those start to narrow down, I'm going to look for squeeze histogram, and I'm going to look for my squeeze exits, right? So here, I'm just going to move this around a little bit on my screen. So from here, let's open this up there. So what I'm going to do is I'm just going to take these off for a second. And what it's going to do is it's going to produce all the entries. That's every single entry on every single candle on this time frame over a 2-year period. Yeah. No, that's just 2022. Let's go down to 2020. I was working on some crypto stuff this morning. That's why it's changed. So here, so trading every one of these singles, you would have done 287 trades, 56% win rate, 1271 extension. So here, where you've got a reasonable probability of winning and a reasonable profit factor, and the average duration of a trade signal was only 2 days, right? That's the key. You can't trade a 60-day call option here. That doesn't make sense, because the average duration is going to be 2 days. So what we would do is we want to now refine this down. So we're going to use an entry from a histogram. So now we can see there was your entry inside the red vol band. You can't trade that because we're underneath the 21. It's a bullish trade. You can only trade that signal here. Once the volatility band goes green, you would have traded from here to here. There was your trade. That was money. 72% win rate, 1.4, 13 days. What would you have done? You could have done a put spread at that point. You could have done one because you had a high probability that the price would rise. Okay. And when the price rises, obviously your put spread makes money. What you could have also done is a long call option that would have taken into account the duration. So you would have gone maybe 30 days out, maybe a 60 delta option, knowing that that 60 delta is going to be positively impacted by the fact that this trade has also got a reasonable amplitude of the move, right? So you could have had a funded trade in here.
Can I interject this question? So I've had a couple of people just we're talking about trading about, so trade duration on long calls, right? And we know that data erodes them. I think everybody kind of knows that if you get something, you don't want to hold it too long, or you know, it's just to lose a lot of value. But yeah. Is there a rule of thumb that you have for, let's say, how long you plan to hold it and the expiration date?
All right. So the planning to hold it and expiration date are not mutually exclusive. Okay. All right. So if I'm going to trade a long call option, what I'll probably defer towards is over what period do I expect the move to take place? Okay. Right. So if the expected move over the next 4 days, based on the options chain, it's telling you what the expected move is. And I'm expecting that move to take place because my oscillators are giving me the indication to an upward move, right? So let's imagine I'm buying a long call. What I might do is buy a 3 or 4 week duration option, but in my plan, I'm going to close it in 3 days.
So I just wondered what was like the, I guess, that zone where you just don't like to play. Like if you're not day trading, like, what is too soon of an expiration?
Okay. All right. On that basis, what you've got to look for is don't trade anything within the 32-day trade window, because if you take the 32-day trade window, so you've got 32 days less, you're trading inside there and you don't really know when you're going to do it. What happens is those options erode really fast. The extrinsic value on that option is going to get wiped out pretty quickly. Remember, the extrinsic value of the option, when you buy it, it's guaranteed to go to zero at the expiration, right? So in that last 32 days, all that fluff that you're paying for, the lack of substance, should we call it, that's all going to zero. So if I'm going to be trading and I'm going to do a day trade on it, I want to pay as little as possible for that extrinsic value if I'm day trading. All right. But remember, I also want a high delta. So it's a trade-off. I want to make sure that I get the move and I want to make the most money out of it. But I've got to be careful. If I buy out of the money and that move goes against me, I'm dead. Right? Because I'm in that window. So for me personally, I will prefer to trade a slightly longer duration on the debit side so that my impact on time erosion is going to be minimized. It's not zero, but it's going to be less than if I bought closer in. It all comes down to your ability to control the trade. If you are not good at controlling the trade, or you're not going to be sitting in front of your screen, be very, very careful about buying close to expiration deltas or close to expiration time type trades and having high volatility in the market. Because you could buy that trade, you could get in, position reverses against you, you're down 70% before you know it. All right, it's really hard. I think that day trading and strike selection and days to expiration and all of that, it's the most tricky part. The entry signal is the easy thing. Like, getting a trigger and telling you to go in, that's the easy part. The hard part is,
I know you like the 60 to 90 day period, or
because it gives me flexibility, right? If I don't get out of that trade in time, I want the flexibility of knowing I'm not going to lose too much if I have to get out the next day or the next 2 days or the next 3 days. Those are important for me. And also when you're trading trends, when you trade, movements above the 21 and in these volatility bands, you need to have time for this trade to work out. And if I've bought a 1 week option and suddenly I bought it here and now I'm here, I'm dead. This trade is gone. It's a finished trade. So you've got to find what the sweet spot is for you. And I will always try and trade. If I'm doing a debit, I'm going to be outside this average duration. If I'm doing a credit spread, I'm going to be inside the average duration. So I always want to have the credits working in my favor. Remember, I want rapid erosion on that trade. So I want to be inside those dates. If I'm doing a long call, I want to be outside those dates, so I don't suffer from the same thing. Remember, in trading, those debits, those long calls, as much as they give you upside, they can give you a real pain on the downside when things start to get volatile. So you want to manage that carefully. Yeah.
So like buying longer duration options and like in the money, you said 60, 70 delta, they kind of,
it's safer.
Effective of time erosion and volatility on the position.
Yeah, it's safer. If you want to go even more conservative, just do a bull call spread. You cap your upside, but because you're getting that credit in and you're getting some sort of delta mitigation via the short, it's a little bit of a safer trade, but you still have to use time on your side. So this is what I stress with people is I can do a trade where I've got 60 days on the call option, but in my plan, I'm closing it on Friday. Like I'll do that. I'll buy that extra time. It's just an easier trade for me to manage than if I buy next week's expiration and we get some intraday volatility and it moves against me and now the trade's dead. Great idea, bad execution. And this is the thing with options is that there are many, many ways to win this game. Many ways. There are, you Google option trading on the internet and you'll find millions and millions and millions of pages. Everyone has a point. The thing at the end of the day is you have to trade what works for you, not what works for someone else. If someone's listening to me and saying, oh, I'm just going to copy what Chris has done, that's difficult because my emotional makeup and my experience level is different from most people. So I'm comfortable managing that trade. If you're not comfortable managing that trade, that setup, and you just try and copy someone, you might win 1 or 2, you might win 10 or 20, but then sometimes your luck will run out and you'll mismanage something and give it all back. So rather than trying to copy, work out which setup works for you. The speed at which the signal prints is really important. I trade the 1 day, the 1 hour, the 30-minute chart. That's it. I don't try and trade the 1, 3, 5. I don't try to trade the 15. If I do day trading, I'll do it, but my predominant strategy will always be on these time frames because the signals print at a pace that allows me to manage the trade properly. If they print too fast and I can't get in, I can't get out, I can't, no, that's not going to be helpful. And a lot of people tend to go into the sort of day trading mindset without the necessary emotional makeup to actually manage a day trade. And then they lose. And then they go, why did I lose? It must be because I'm a crappy trader. You're probably a great trader. You just haven't worked out what to trade yet. You're taking the guidance from someone who's already been through that learning curve and assuming it will work for you. Never assume anything in options trading. You should always look at your options trading and go, okay, great idea. If someone looks at the way that I analyze, there are many people, when I talk about this, the system that I've built, who will say, I use too many indicators. And I go, well, it works for me. So it doesn't mean that it's wrong. It also doesn't mean that the other guy's right. There are going to be many opinions. Option trading is like religion. There's many ways to get to heaven, right? There are many paths to heaven. So don't fall for the trap of thinking that one system beats all, or one indicator beats everything, or no, it doesn't work like that. You have to find what works for you. And what I've found over the 20 years that I've done this is I'm a lot more confident in managing a trade where I've had confluence of signals, because statistically, if a lagging indicator and a leading indicator give me the same conclusion using different sources of data or different fields of data, in the past, in my track record, those are the trades that tend to work the best. Okay, so I'm just going to look for that alignment, right? And that's what we do with the tools. We look for the alignment, we then trade it conservatively, scale in, and if it breaks, it breaks. We don't get upset about it. We don't look at it and go, oh, I'm a crappy trader, I shouldn't have taken that trade. If the system says, when we've got green, when you've got green, 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 do a trade. Like, that's how it works. We've got a green vol band, we've got a strategy, a moving average cross, a stochastic or a histogram, our volume, our stochastic, we trade. And we can see visually that those have always worked. So we always look for that scenario to repeat itself. So rather than someone coming up and saying, oh, you know what, you should buy Tesla for the, let's add in Tesla, right? Why would I trade Tesla? It's got a red volatility band. It's under the 21. I've got a squeeze firing short. My stochastics at 0. I've got a negative crossover, a bearish crossover of my MACD. I have nothing bullish here. Yeah, sure. Oh, it's going to open up today. Yeah, so what? Doesn't make a difference. Doesn't make a difference. We need to get this back up here above this line before we can go long again, right? So this is the sort of control that you have. You don't just dive into a trade. Have a process that allows you to see things in a more clear way. We have no support on the hourly to the daily, right? This is not bullish. So if the hourly is not bullish, the daily can't be bullish. The hourly has to be bullish first. If we go into the 30-minute chart, you'll see at the top here, we're still under the 21. There's the 21. Until that gets above there, which is 1006, we're not going to see this get above 1022. It's got to reach these levels first, right? And at this point, there's still a lot of downward pressure. Here you can see the stochastics oversold. We've got a squeeze that's 5 short. Here, stochastics oversold. Squeeze is getting less bad, but there's potential. We won't say that there's no potential. There's potential, but not now. You're going to have to wait a few hours for this to move back up. You can see it on a lot of the trades. Let's look at AVGO. Below the trend line, below the 21 in a red volatility band, price is going to jump up. It's going to gap up the open. Why? Because this is such a chronic oversold condition. Yeah, you can see oversold, volume is negative, squeezes fired short. Can this stay here? Can this bounce and go this way? Well, it's going to have to work through that squeeze. Let's look at the hourly. You see how the hourly is below the 21, red, negative, oversold. Look at the 30-minute, red. Why would you trade this? Even this movement here up to 594, it fixes the 30-minute chart, but it doesn't fix this. It's still got to close twice above that 21 before we can actually start looking at it. So the way that we try and do this is have a watch list and just keep watching your watch list. If your watch list suddenly starts to change, and you will see this by the price movements going green in this column here, then you've got to trade. But don't trade something that's not on your watch list just because someone sent you a text message. That's not a healthy way of doing anything, right? So here in the pre-market, we've got a couple of stocks that are moving up. Tesla's going up. Let's look at service now. So here, Divergent low bar. When it prints purple candles, we know prices go up. Orange candles mean prices go down. Purple, price goes up. Purple, price up. Orange, price down. Purple, up. It's a pretty simple piece of logic, right? If we have a purple candle, can we trade this? Now, could we trade this trade today? No, because we have earnings coming up. Purple candle says higher prices, but I cannot trade this until this gray cloud goes green. It's going to go green if it breaks the 21. This has to get up to 555 before we can trade this. So 555 is up here. It's up at that zone there on the hourly. So it's got a lot of work to do to get there. On the 30-minute, squeeze looks like it will fire short. Yeah, you can see the stochastic turning to the downside. There's a lot of work that needs to be done before you can trade this, but doesn't mean there won't be a trade in 3 or 4 days. So in 3 or 4 days, we could see this price up here moving up into this zone there. That might be the trade from 560 to 590. You know, which is the safer trade? Buying here and hoping for the best, or buying up here and getting it into this zone with that small little resistance piece to get through. If these are bullish, you can get in there. And you've got to do that before earnings. So it's all got to happen before the 27th of April. So when you build a plan and you build a set of triggers and you build a set of tools, your strategy that you can use is when I get that signal, when this squeeze signal fires off, it's got a 60-odd% chance of winning, 1.3, 14-day. That's a 21-day option, probably the 60 delta. But I'm not going to get that signal until this histogram crosses 0. So I know that I'm not going to get a signal here, at least for the next few days. So, you know, that's what we want to try and avoid, is doing these kind of trades. But that's about it, man. I think that market's going to close now. Oh, sorry, it's going to open now. And we can get started with the day. So thanks,
awesome,
man.
Yeah, Chris, look forward to it as always next week. Guys, check out Rogue Investing / last time I said I was too tired. / Alpha Hunter or Alpha. See, I messed it up again.
There you go, man. It's okay.
In the notes on YouTube, right? So / Alpha. Check out Chris's products, new stuff, editorials, a lot of stuff there. So Chris, good luck today.
Thanks, buddy.
And have an awesome week. I'm glad you're feeling that.
Thank you, man. I'll see you next Tuesday.
Yep.
Take care, bro. Cheers, man.